In the latest session, markets drifted slightly higher as healthcare surged over 3% to lead a sharp, defensive sector rotation across the board. The leveraged semiconductor ETF fell 6.5%. Moat score, data not available. Global AI chip orders are projected to hit $171 billion this year, up 23% YOY. That demand underpins the leveraged semiconductor ETF's structural durability case, driving leverage exposure to soaring fabs. Our full teardown shows why hardware demand trumps any moat score, period, definitely. SOXL dropped 6.48% to $120.74 as structural leverage punished semiconductor volatility. The Direxion Daily Semiconductor Bull 3X shares fund magnifies daily moves in the SMH benchmark by 300%. That daily reset mechanism creates severe volatility decay during choppy multi-day holding periods. The underlying engine relies heavily on three core semiconductor powerhouses. NVIDIA commands 20.8% of fund exposure as primary compute demand dictates daily direction. Taiwan Semiconductor represents 9.6%, operating as the critical foundry bottleneck for advanced packaging and lithography. Broadcom holds 6.6%, controlling critical custom silicon and optical networking switches across enterprise clusters. Memory innovation powering a new AI infrastructure cycle demands massive silicon capacity across these key players. Yet when leading hardware components pull back simultaneously, the 3x daily multiplier accelerates downside pressure across the instrument. NVIDIA and Taiwan Semiconductor alone dictate over 30% of daily price variance. Broadcom adds custom ASIC exposure, binding fund returns directly to hyperscaler capital expenditure momentum. This mechanical gearing exposes capital to rapid drawdowns whenever foundational semiconductor components experience concurrent selling pressure. The combined weighting creates an aggressive vehicle engineered strictly for single-day directional precision. Open the hood on the leveraged semiconductor ETF. The largest single dragging, LRCX at -6.3%, carrying 4.5% of the fund. Direxion delivers zero ambiguity with SOXL, though specific fund AUM and expense ratio figures remain unlisted data. The portfolio structure concentrates 48% of total net asset value inside its top 5 holdings. NVIDIA leads at 20.8%, followed by Taiwan Semiconductor at 9.6% and Broadcom at 6.6%. Advanced Micro Devices claims 5.7%. while Micron Technology holds 5.2% to capture memory architecture growth. This is not diversified exposure. Marketing claims of broad semiconductor access disguise a concentrated megacap compute bet. Benchmark comparisons reveal the structural cost of daily compounding over rolling monthly horizons. Over the past month, base benchmark SMH fell 4.4%, while SOXL lagged it by 20.6 percentage points. Multi-day volatility decay erodes baseline performance whenever underlying equities lack sustained unidirectional momentum. Yet the strategy delivers when momentum aligns, generating 171.9% year-to-date and a 97.9% three-year average. The instrument captures raw hardware expansion efficiently during sustained rallies, but its heavy concentration magnifies structural reset drag. The fund functions as an aggressively designed daily directional amplifier rather than a stable sector allocation vehicle. SOXL is trading at a 20.4% discount to NAV. That's not a rounding error. It's a full-blown retail exodus. While the fund's marketing still sells 3x daily semiconductor leverage, the market is screaming that the narrative is broken. The 5-day to 20-day volume ratio sits at 0.82, neutral on paper, but when paired with that discount, it tells you institutional money isn't stepping in to catch the knife. They're watching from the sidelines, waiting for the next policy headline to drop. RSI at 52.9 and price below both the 20-day and 50-day moving averages? That's not momentum. That's a sector stuck in limbo. The bullish MACD crossover is the only green on the board, And even that's fading into noise when you see the YTD gain of 171.9% versus a 3-year average of 97.9%. The lab doesn't buy the AI-driven semiconductor supercycle narrative when the fund zone structure is eating itself alive. Reset mechanics and fee drag are eroding compounding, and the discount proves retail investors finally see it. Mainstream media is blaming Trump tariff uncertainty, but the lab calls it differently. The real story is hardware commoditization. Memory innovation at FMS 2026 shows Samsung is already shipping next-gen AI memory, yet SOXL's top holdings are still riding last year's node. The narrative sold to retail is leverage the chip boom, but the fund's composition is still tilted toward legacy fabs that are losing margin to foundry consolidation. The discount isn't a buying opportunity, it's the market pricing in structural decay. Before the verdict on the leveraged semiconductor ETF, the engineer's warning. 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at -1%, but the leveraged semiconductor ETF at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. The structural durability case for SOXL rests on undeniable hardware demand, driving 171.9% year-to-date performance. Sustained data center infrastructure build-outs continue funneling capital directly into Tier 1 silicon providers. The primary downside catalyst stems from strict United States export controls on advanced artificial intelligence chips to China. Expanded trade tariffs directly restrict revenue capture for foundational holdings that rely on international distribution channels. NVIDIA and Taiwan Semiconductor represent 30.4% of fund exposure, concentrating geopolitical vulnerability inside 2 corporate balance sheets. A sudden policy clampdown on wafer shipments or packaging equipment immediately impairs baseline net asset value. The lab monitors 2 specific structural signals to gauge operational health. First, watch top 5 portfolio concentration to verify whether weightings exceed the current 48% threshold. Second, track daily tracking error against underlying index movements to identify excessive volatility decay during market chop. Daily RSI currently sits at 52.9 alongside a bullish MACD crossover, confirming neutral technical equilibrium without extreme exhaustion. The lab assigns SOXL an AI ETF score of none out of 100 for structural holding durability. Daily derivative resets eliminate long-term structural durability across volatile market regimes. Benchmark tracking efficiency against daily SMH percentage moves remains the single critical metric dictating operational precision. Before we close, if you're holding the leveraged semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 3.1%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. SOXL's daily data blackout hid the real signal, leverage decay in a sideways tape. Is the leveraged semiconductor ETF's moat strengthening or eroding? Let's hear your evidence. Remember, this isn't financial advice. We're engineers, not brokers. Markets change, past returns don't repeat, and you should always run your own numbers before pulling the trigger. Subscribe so you don't miss Thursday's deep dive. We're tearing down Micron. The lab stays open.